Hello students, I hope you are fine wherever you are. I know that to some of you it's an evening, to others it's a good morning. So whatever time it is, I just say I welcome you all to this week's lecture on double entry bookkeeping, accruals and prepayments. So without wasting much of your time, let us go straight to our objectives. Okay. I'm sure you still remember that last week we covered part of the duality concept where we said that every transaction a business enters into has got two effects. Okay, either something is increasing or something is decreasing, or somebody's giving and somebody's receiving. We also touched the aspects of the structures of the statement of financial position, as well as the statement of profit or loss. Okay, let me just pick a pen color here. Okay, so by the end of this week, as part of our double entry bookkeeping exercise, students should be able to explain the concept of double entry and the debit and credit principle, distinguish between asset, liability, revenue and expense accounts, explain the meaning of the balance on each type of account, record cash transactions in ledger accounts, record credit sale and purchase transactions in ledger accounts, illustrate how to account for discounts, explain sales and purchase returns and demonstrate their recording, illustrate how to balance a ledger account, extract the ledger balances into a trial balance, prepare a simple income statement and balance sheet from a trial balance, and lastly, explain and illustrate the process of closing the ledger accounts in the accounting records when the financial statements have been completed. So these are our objectives with regards to the double entry bookkeeping system. Alright? Now, the duality concept stipulates that every transaction the business enters into has two effects. However, the following rules of double entry bookkeeping state that each time a transaction is recorded, both effects must be taken into account and the two effects are equal and opposite, such that the accounting equation is always proven correct. And I'm sure you still remember the accounting equation, which says that assets minus liabilities is equal to capital. This is the same as assets is equal to capital plus liabilities. Okay, this is just a rearrangement of the equation. Traditionally, one effect is referred to as the debit side, abbreviated as DR, and the other, the credit side, abbreviated as CR. Okay, recording transactions in the ledger. Transactions are recorded in the relevant ledger accounts, that is, in the general or nominal ledger. When we are talking of ledger here, this is an accounting record, okay, that is where all financial transaction is recorded. Everything that occurs in the company should, at the end of the day, reach the general ledger. General or nominal ledger. Alright, you will see that there are so many ledgers, but when we are talking of the general or the nominal ledger, this is the ultimate ledger where all transactions, whatever transaction we are talking about, should actually be explained by the general or nominal ledger. It is different from other ledgers. If you still remember in our previous lecture when we talked about the books of original entry or prime entry, we talked about the sales daybook, purchases daybook, okay. Now, and also the cash book. These are books of original entry, okay. But the cash book is actually also part of the double entry bookkeeping system, so it is also part of the general ledger. However, for the purpose of this explanation, let us say, now, when a customer comes to buy something on credit, we record that transaction initially in the sales daybook, okay. But because it is a credit transaction, there should be what is called a receivables ledger. Okay. Similarly, if we buy goods from a wholesaler on credit, okay, we record such transaction in our purchases daybook, okay. But we then transfer that information to the payables or purchases ledger, okay, payables ledger. Then we also transfer this information to the general ledger. Even the payables, even the purchases are also transferred to the general ledger, okay. You understand when we do control accounts what we mean here, all right. So the books of prime entry, they provide information to the receivables or payables ledger, okay, the receivables as well as the payables ledger, but they also supply direct to the general or nominal ledger. But you discover that these ledgers, they do not communicate directly, okay. The receivables ledger, when an accountant is preparing the general ledger, okay, he does not obtain his information from the receivables or the payables ledger, all right, but he has to rely on books of prime entry, all right. This is the reason when we do control accounts, we would want to ascertain if the information that is being availed by the receivables ledger or the payables ledger is tallying with the control accounts total, which are found in the general or nominal ledger. Okay, you understand that when we move with the lectures. Now, transactions are recorded in the relevant ledger accounts in the general or nominal ledger. You discover that from these or in this general ledger, they are what are called ledger accounts. Okay? There is a ledger account for each asset. We are talking of ledger account, ladies and gentlemen. This is a ledger account for each asset, liability, revenue, and expense item. Okay? Each account has two sides, the debit and credit. Whether it is revenue, whether it is an asset, whether it is an expense item, they both have what is called the debit and the credit. So you see that an account, a ledger account is a form of a T account. This is why you are seeing this line, okay, as well as this one. Sometimes they are referred to as T accounts. So it should have a debit side and a credit side, as well as the account name, whether it is a cash account, a sales account, an expense account, etc. Okay, you also find that there should be the date of the transaction and the transaction's narrative or narration. The dual effect principle means that each transaction will affect two ledger accounts. Alright? So whenever a transaction has been entered into, two accounts will be affected. For example, let's say we buy bread on credit. Okay, let's say we buy bread on credit. Here, the two accounts which have been affected are the bread. Okay, we're going to debit the asset bread, the bread account. Okay, bread. But at the same time, we consider the bread as purchases. Okay, all right. So we debit purchases, or we just say debit bread, and credit the supplier, who is a payable. So you can see that two accounts have been affected: the bread account and the payables account. All right, that's the two effects we are talking about. These are the two effects we are talking about. So one account will be debited, the other would be credited. Okay. So how do we record this transaction? Whether an entry is to the debit or credit side of an account depends on the type of the account. I'm sure you still remember we talked about the PREPAYMENTS acronym. Okay, let me just look for another pen color. Okay, we have got the PREPAYMENTS acronym. The PREPAYMENTS acronym, where we say that in the middle here we just draw a line, okay, and say that these guys have got a debit. They are debits by default, and these ones are credits by default. So the P stands for purchases, E stands for expenses, A assets. Okay, then the R stands for revenue, L liabilities, S things like share capital, etc. All right. So if we want to increase assets, we debit them. If you want to increase expenses, we debit them. If you want to increase assets, purchases, we debit them. All right. If we want to reduce them, we credit them. So debiting in terms of purchases, expenses, or assets, we are saying we are increasing them. But when we want to reduce them, we say credit assets, credit expenses, credit purchases. Similarly, revenue is a credit. Revenue, income, etc., or sales, they are credited by default whenever they are being increased. So this is why you are seeing here assets, they are increased by debiting, all right, but liabilities are reduced by debiting. Okay, why? Because liabilities by default, we said here that they have got a credit, they are credits by default. So when you want to reduce liabilities, you debit them. Okay, expenditure, this one is increased by debiting, but you want to reduce expenditure, you credit it. Okay, revenue, that's income. When you debit revenue, you will be decreasing it. Drawings, when you increase them, you are debiting. All right. Similarly, on the credit side, okay, on the credit side, this one was just a typo. Okay. When you want to increase liabilities, we credit them. When you want to reduce assets, we credit them. When you want to increase expenditure, we say that it is being debited. But when we want to reduce it, you credit it. Okay? This is the purpose of crediting. We'll be reducing expenditure, increasing revenue, increasing capital. Why? Because the PREPAYMENTS acronym is also in concurrence with the accounting equation that says that assets is equal to capital plus liabilities. Okay, these assets by default are debits and capital and liabilities are credits. Okay, the debit side and the credit side should always be equal. Alright, so you can see that the PO's acronym actually follows our idea of assets is equal to capital plus liabilities. Alright, so this is why we say the PO's acronym stands for purchases, expenses, assets, okay, revenue, liabilities, share capital, etc. Now, this is the summary of steps to record a transaction. What you need to do first is to identify the two items that are affected. In our bread, for example, we say that the two accounts that are being affected are the bread account, that is the purchases account, okay, and the payables account, that is the suppliers account. Then consider whether they are being increased or decreased. In our case, when we buy bread, we are increasing bread. So this is why we debit bread. Bread is an asset. And credit the giver, who is the supplier. Decide whether each account should be debited or credited. Yes, we did that. Then check that a debit entry or a credit entry has been made and they are both for the same amount. They should equal. Accounting for discounts. You will discover that in the course of business, companies might be given discounts by their suppliers. When a company has received a discount or has been given a discount, we call that one a discount received. But when that company sells goods to a customer at a discount, we call that discount allowed. So the correct double entries are for discount, a discount allowed. This is an expense, so we debit expense and credit what? Remember, when we are talking of discount allowed, this is a discount that has been given to credit customers. Okay, so credit customers, they are also called receivables. Credit customers are also called receivables. So when we give a discount to a customer, we are incurring an expense. It is an expense to us. Okay, it is an expense. So we are reducing the amount they were supposed to give. If they were supposed to give us $100, but we are giving them a 10% discount, it means that they are going to pay $90 only. So the $10 has been an expense to the business. So we are reducing the receivable. Receivables by nature, they are assets. Receivables are assets. So from our PO's acronym, please always remember the PO's acronym. The PO's acronym, we said that if we are increasing this side, we are debiting. Okay? But when we want to reduce this side, we credit. This is why you are seeing these receivables. They are assets, but they are being credited because they were $100 initially, but because we have given a discount, they have been reduced to $90. So the $10 here, this is the crediting. The $10, we are reducing the receivables by $10. Okay, so we are crediting receivables by $10 here, $10, and the discount which we have given to the customer, which is an expense to us, is $10. So $10 and $10. So debit discount allowed, which is an expense, by $10, and credit the receivables account by $10. Where do we show this expense? This expense is shown beneath the gross profit in the statement, in the income statement, alongside other expenses of the business. What about when we receive discount from our creditors, or payables? We say that one is called discount received. So what happens is we are going to debit payables. The payables, these are liabilities. Liabilities are payables. And we say that these guys are by nature credits. They've got a credit balance. But when we want to reduce them, we have to debit. We debit to reduce them. So this is why we are seeing here debit payables for creditors, okay, and credit discount received. Because discount received is income, all right. Discount received is income, all right. So by nature, when we have received money, we have to credit the income. We have to credit the discount which we have received. Okay. So in this case, payables are decreasing, income is increasing. And when I said when income is being increased, we are following the PO's acronym. When income, because I said revenue is also called income. This is income, liabilities, and share capital. When we want to increase the revenue, we have to credit it. We credit it. So discount received is income. This is why it is being credited here. I'm sure we are together. All right. Let us go through the example on discounts so that we understand what is going on. George owes a supplier Herbie $2,000 and is owed $3,400 by a customer. All right. So this guy, he owes a supplier $2,000 and is also owed $3,400 by a customer, Iris. Iris offers a cash discount to her customers of 2.5% if they pay within 14 days, and Herbie has offered George a cash discount of 3% for payment within 10 days. George pays Herbie within 10 days and Iris takes advantage of the cash discount offered to her. Write up the ledger account payables, receivables, discounts received, and discounts allowed. Okay, I think the example had been previously miswritten. Okay, there was a typo, so I think this is the correct wording now, which we are seeing here. Let me just pick a pen pointer. All right, so we are having a situation where George owes a supplier Herbie $2,000 and is owed $3,400 by a customer, Iris. George offers a cash discount to his customers of 2.5% if they pay within 14 days, and Herbie has offered George a cash discount of 3% for payment within 10 days. George pays Herbie within 10 days and Iris takes advantage of the cash discount offered to her. Write up the ledger account for payables, receivables, discounts received, and discount allowed. And this example is actually a very, very, very good example for us to learn about the T accounts and the discounts and so forth. So let us start by the payables account. So the payables account, all right, like I said, it is a T account, and this is how you draw a T account. And if you still remember from our PO's acronym, PELs acronym, payables are liabilities. Okay, payables, these are liabilities. Okay, and liabilities are increased by the credit. Remember, this is the debit side. Okay, so they are by default, liabilities are by default credit. So they've got a balance brought forward on the credit side. So in this case, we are being told that George is owing a supplier $2,000. So the balance brought forward already is $2,000. Okay, but we are also told that George paid Herbie within 10 days. So he had paid this guy within 10 days. But how much did he pay? How much did he pay? Okay. Okay, we are told that this George wanted to enjoy the cash discount that comes with prompt payment. So if he pays early, he was going to enjoy 3%. Okay, because Herbie had promised that if you guys pay within some time, within 10 days, then we're going to enjoy a 3% cash discount. So George did the same and he was given that discount. So how much cash did he pay? Obviously you should pay cash of or with 97%. Okay, 97% of $2,000, and that was supposed to be 1940. So why are we writing the cash this side? If you still remember from our from my introductory statements, I said that to reduce the payable, remember the payables is a liability. This is a liability account. At liabilities, we said that liabilities are by default credits. So the balance brought forward for a payable started with a $2,000 here. Okay, this was the liability, the amount which George was owing to the supplier. However, he reduced this amount by paying a certain amount, that is 1,940. So to reduce the credit, you have to debit. So this is why we are writing a debit entry. Remember, this is a credit entry. So this is why you are seeing the entry has been made on the debit side, the cash of 1,940. But you can see that 1,940 is not equal to 2,000, because by the end of the day, the ledger account should have the same balance on both sides. So there should be some balancing figure. Okay, the balancing figure here is known as the discount received. We received a discount of 60. Okay, that's the discount which was received. So if you add the discount received and 1,940, the cash which was actually paid, you will come to 2,000. And this suggests that there is no balance carried forward, because the liability has been settled and is now completely paid. So that's the payables ledger account. Let's now do the receivables ledger account. So receivables account. Similarly, we've got the debit as well as the credit. Okay, now receivables are by default debits. From our PO's acronym, receivables are assets. So they are debits by default. So there is a balance brought forward on the debit side. Balance brought forward. How much was the receivable? The receivable is amount which you expect to receive from a customer. So they are also called credit sales. They are receivables. So this was 3,400. So that's the balance we put here, 3,400. Okay, you can put your dollar signs here. And then what do you have to do next? What you have to do is you have to worry about how much cash was actually paid by the customer. We are only going to know that after we consider the amount of discount which was allowed, and we are told that George offers cash discount to his customers of 2.5% if they pay within 14 days, and we are told that Iris took advantage of the cash discount offered to her, so which means that Iris paid within 14 days, so she was entitled to a discount. So how much cash did she pay? She only paid cash worth 97.5% multiplied by 3,400. Why are we saying 97.5? Because the actual amount, this 3,400 is a 100% figure. So if we are given a 2.5% discount, so we have to deduct the 2.5 from 100%, and we are going to be left with 97.5%. So this is why we are writing the 97.5% there. I'm sure you are no longer lost. So let us just erase this just for illustration purposes. Okay, going ahead. So how much did they pay? 97.5% of 3,400. We get 3,350. Okay. Now we are also told that this guy allowed a discount. So discount allowed, which is the balance here, or the difference, because we said 97.5 was the actual amount paid. So we just say 3,400 minus 3,315, and we get the difference of 85 bucks. You can also then have to balance off the account. Remember, the larger side should always appear on both sides of the account. All right. So if you add up 3,315 and 85, you come to 3,400. All right. But this figure can also be found by saying 3,400 multiplied by 2.5%, and you get the same answer as $85, which was the discount which was received. Allowed. Okay. Now, you also need to come up with the ledger accounts for the discount received and discount allowed. They also have got their own T accounts. So for the discount received, we calculated this one here. The discount received, we discovered that it was $60. Okay. So, but what is important is to know that discount received is income, and income is credit. As you have seen here, revenue is on the credit side. So the discount received account should have its balance on this side. Okay, the $60 should appear on this side. But what is the narration? The narration is that it is emanating from a payable. So credit the discount received account with the payable of $60. Similarly, for the discount, does you have space? No space. Okay, for the discount allowed, this is an expense, so the discount allowed account should be having a receivable here. Receivable. All right, receivables, and we discovered that this was how much? $85. Let's say generally these are the T accounts which were required by our example. So let us move on to balancing the accounts. Alright, in the previous slide we learned how to record entries in the ledger. However, before we can go further, we need to calculate the net figure or balance on each account. The following rules for balancing apply. The first thing you have to do is to draw total lines on both sides of the T account. Okay, add up the bigger of the two sides and put this total on both sides of the account, which we did. We illustrated here how to record. This is that's totaling, and these are the totals which are being referred to. Okay, that's the total there. You then have to add up the bigger side, and if you can see, the bigger side was 3.4. That is why we put 3.4 here. Okay, fill in the missing figure on the smaller of the two sides. This figure is the balance on the account. Okay, carry forward this balance by also writing it on the opposite side of the account below the total lines. Right, the figures above the total lines can now be effectively ignored because we have replaced them by the net figure or balance below the total lines. The following example is essential. So let us go through this example to understand what we are referring to. So Rachel's business entered into the following transactions during a first month of trading. Record each transaction in T accounts or ledger accounts and then balance off the accounts. So we are told that Rachel starts a business and pays in $5,000 as capital. Remember that every transaction in which a business enters into has got two effects, as we have already pointed. Okay, we have already pointed that something could have happened. Okay, so we need to come up with the ledger accounts which are applicable in each case. All right, in each case. So if somebody Rachel starts a business and paid 5,000 as cash, what is being debited? Well, obviously we're going to debit cash. That's the first thing, and credit capital. That these are the two effects which have resulted. So we debit cash 5,000 and credit capital 5,000. All right. What about a business buys a car for cash? So if we have bought a car for cash, obviously we are going to debit. We're going to debit car and credit cash. Why are we crediting cash when cash is an asset? In this case, even if cash is an asset, but we want to reduce cash, we want to reduce this asset. So to reduce the asset cash, we credit the cash. I'm sure you get the sense now. I'm sure we are now moving together. So let us now come up with the T accounts for all these transactions. All right, but let us finish them. Buy goods for resale for cash. So in this case, goods for resale. The goods for resale are called purchases. So we bought these purchases for cash. So we're going to debit purchases. Remember the PO's acronym, and credit cash. How much was that? 500. This one 500. For the car, we didn't put the amounts. We're talking of 1,000, 1,000. Now, what about here? They buy goods for resale for $600 on credit. So these ones are purchases, but they are now on credit. So we're going to say debit purchases 600 and credit supplier, Mr. A. You can also say supplier or payable. Okay, how much? 600. They should have similar amounts. They pay rent. They pay rent $200 cash. So the expense This is an expense, rent, debit rent, because it is an expense, 200, and credits cash, 200. They sell the remaining, they sell half of the goods for $800 cash. Okay, so we are receiving debit cash $800, and credit sales Remember, sales are revenue. On the PL's acronym, revenue, 800. Okay? But you also need to know that the inventory items have also reduced. Okay? The inventory items have also reduced in this case. So inventory was also reduced. So inventory should also be credited with the cost, the actual cost of the inventory, not to be reduced by $800. No, it is only to be reduced by the actual cost of the inventory. Okay, they sell the remaining goods on credit for $900. So these ones, they were sales. So I go to debit the receivable, Mr. X. This is a receivable. It's an asset, $900. Sorry, 900, and credits sales, 900. But also know that the inventory was also reduced. Half of the inventory was also reduced when we made the sale. So there should be some adjustment on the inventory. So, but we're told that everything now has all been sold. So on the inventory part of it, we are going to have a 0. They pay 400 cash on account of the amount owing to Mr. A. So Mr. A, we paid cash. So Mr. A is receiving. So debit Mr. A, who is a payable. Okay, he is a payable. We owe him money. So a payable is a liability. So when we are reducing, because we are paying, we are reducing the liability. So this is why we are debiting the liability. Okay, $400, and crediting cash because our money is getting out of the business. So crediting cash, $400. So which account now is left? We've got, they receive $500 from Miss X. Miss X was a receivable. If you still remember, Miss X on G here. Okay, we sold the goods on credit for $900, but here we are receiving $500. So we are debiting cash. So cash, right? Debit cash, 500. Okay, and credit Miss X or receivable. Miss X, she's a receivable. Okay, and when we are crediting a receivable, we are reducing the asset, we are reducing the receivable balance. Okay, we are reducing the amount we expect to receive from customer because the customer is paid, so we are reducing that amount by $500. Then lastly, Russia withdraws $100 cash from the business. Here, drawings are a reduction of profits. Okay, drawings are a reduction of profits. So what happens when we make drawings? All right, we debit drawing. This is a reduction of the business cash. Okay, so we debit drawings. Russia is receiving money, so debit drawings, $100, drawings or withdrawals, and then we have to credit cash because the cash account is reducing. Okay, Now that you know what is happening and what is going on, then you have to present in ledger accounts. This was just the double entry, what was happening. Okay, but we now need to come up with ledger accounts, the relevant ledger accounts. So those ledger accounts should actually be accounts which are meaningful. Okay, they should be meaningful. So what happens is we go here, we just do step by step. So let us start with the cash account. How do you know that this account is relevant or should be done? You can see that the cash account is affected. Here the cash, the cash, the cash, the cash, the cash. There's also the capital account, alright? Capital account, we have got the purchases account. All those accounts have been affected. We've got the payables, the receivables, all those accounts were affected. So we need to attack each account as it stands. Alright? So let us get going. Now, we can start with the cash account. The cash account. Okay? And let me just erase a bit for the purpose of having enough space. How many pages do we have? Let me just cross-check, see if we have got enough space. Okay, it seems we are right on track when it comes to spacing. Alright, so the cash account, you know from your POs acronym. Let me just rewrite the POs acronym here. The POs. Please don't forget this. This is the debit. This is the credit. Now, we are told this guy, Rachel, puts in money in the business at the start here of $5,000. So she paid the cash into the business, 5,000. And you know that the business and the owner, they are separate people. Okay, they are not the same. So this is why we are saying that Rachel had to pump in money into the business. Okay, this money is now being accounted as business money, not Rachel's money. All right. So when cash, is being increased with debit, cash is an asset. Cash is an asset. Cash is an asset. So when we want to increase cash, we debit the cash, so we put it on the debit side of the cash account. So here we say that this money which we received was capital, and how much was it? It was $5,000. Okay, then we go back to the question, anything that happened for cash. The business buys a car, $1,000 cash, so the cash account was affected. Excuse me. Okay, so the cash account was affected by how much? $1,000 for the purchase of a car, so 1,000. Why is it being written? This is the debit and this is the credit side. Why are we writing 1,000 on the credit side? Because we want to reduce the cash account. Money left the business, money left the cash account to buy a car. So this is to reduce the cash account. We have to credit it, or to reduce an asset account, we have to credit it. So simple, isn't it? Then we go back. They buy. So in the exam, you can actually tick what we've covered so far. We've done this. Then they buy goods for resale for $500 cash, and we say that the double entry was debit purchase is 500 and credit cash 500. So on the cash account, we are going to write this credit entry because we bought goods on cash. So this is what we are going to do. We are going to say we bought purchases. How much? 500. Okay. So let me just try to erase a bit because there's now a clutter of things. Okay, I'm sure. Okay, right. Let's proceed a bit, because if we raise some information, it's still important. Okay, they buy goods for resale. We covered that one. Done. Then they buy more goods for resale for $600 on credit. So these goods were bought on credit. Do they affect the cash account? Obviously not. They're not going to affect the cash account, so we skip. Then they pay rent $200, so by cash. So there's $200 left in the cupboard. So we say that rent 200. Then, so this one done. They sell half the goods for $800 cash. So cash came, and these were sales. If you still remember, we made a double entry here where we say that debit cash $800 and credit sales $800. So the cash which we debited is going to be debited, obviously, on our cash account. So this is sales debit 800. All right. So this one is done. Then they sell the remaining goods on credit for $900 to Miss X. So, but this one was a credit entry, so we ignore it. They pay $400 cash on account of the amount owing to Mr. A. So the payable was paid $400. So payable $400. Then they receive $500 from Miss X. So a receivable paid us. So this is why we said debit cash 500 and credit Miss X. So we have to write that receipt for Miss X. Okay, receivable. The receivable of $500 from Miss X. Okay, another transaction relating to cash. Rachel withdraws $100 cash from the business. So there are some drawings there. Drawings, $100. Okay, so it seems we have exhausted everything to do with cash. So we then have to total up the accounts as we have read there. You can as well leave a space. Okay, you can just leave some space in case something might come up. Okay, so you can assess which side is larger. The larger should have its balances written in both of the totals. So in this case, that's 5,000 plus 800, that's 5.8 plus 500, 6.3. 6,300. 6,300. Okay, then you discover that the credit side is smaller, so that's where we are going to have a balance CD. And the balance CD is going to be, the balancing figure here is going to be 4,100. And we are told that this figure should be transferred across to become balance B brought forward of 4,100. So what this means is that we only have got 4,100 left in our cash account after taking into consideration all the cash we received as well as the cash we paid out. So in the exam you may be asked, do we have a debit or a credit balance? Obviously this is a debit balance because it is on the debit side of the account. So the side where the balance brought forward is, that's where the account balance is said it will be. okay, whether it is a debit or a credit, it is only determined by the side at which the balance brought forward is. The other trick the examiner might say, he would say, after casting the cash account totals on both the debit and the credit sides, the debit side was found to be having a larger figure. Okay, let's say in this case, the debit side was found to be, let me just change the pen for illustration purposes. Let's say the debit side, when you were doing your casting, you discover that the debit side was 6,300, but this side, it was, let's say, 2,000. Okay, let's say this side was 2,000. So the examiner might ask, where should the balance of this carbon be? I mean, of this account be? Obviously, the balance of the account, the ultimate balance or the balance brought forward of the account should be where there was a larger amount. Okay, and in this case, the debit side. So it's very simple. All right, it's very, very simple. But you just have to show the examiner that you are mature enough to know that. Okay, let us finish a very short account here, that is the capital account or capital ledger account. The capital ledger account, the capital account. Capital T account. And I say that the capital by nature is on the POs. If you look here, the share capital is also a credit balance. So its balance brought forward, the capital should also be on the credit side. So this capital was in the form of cash, not share capital, but cash. So cash was injected in the business by the owner, so thus we are having it on the credit side of that account. Alright, what about the other T account we can think of? We can think of the car, okay, the car account. The car, a car is an asset. Obviously, the balance for the car should be on the debit side, okay, the balance for the car transaction was spoken on B here. The business buys a car for cash 1,000, and we say that this transaction affected the car account 1,000 as well as the cash which was credited because we bought the car on cash. So we're going to slot the 1,000 on the debit side. Okay, it was bought for cash. Done. Then we can also think of another T account, which is a very, very simple one. The T account for purchases. Let us talk of purchases. Purchases account. The T account, and we say that purchases are increased by debiting from the PO's acronym. This is the P we are talking about. The P, purchases. They are increased by debiting. So obviously we are going to have a debit account there. So there were two types of purchases. Okay, the first type was C. They buy goods for resale for $500. This was the first one, and then they buy more goods for resale on credit. So we are having both the cash and the credit purchases. So this is how we are going to record them. The first one, the cash one, just write cash 500, and then payables 600. All right. Then we total up 1,100. Okay. Thus balance CD 1,100. We're going to have balance PD 1,100. Okay, and we can move across for the payables account itself. The payables account is different from the purchases account. The payables account only explains details about purchases which were bought on credit. Okay, so payables are liabilities, so by nature they should have a credit balance brought forward. In this case, we are having purchases of how much? They were $600. All right, but we are also told that these purchases, some of them were paid. They pay $400 cash on account of the amount owing to Mr. A. So the 400 part of it was paid. So if 400 out of this 600 was paid, where are we going to record this 400? If we record it below here, we are going to increase. We'll be increasing because that's the credit side of the payables. But we have to write it here, the cash, to reduce. This is the debit side. This is the credit. So 400 was paid. So if 400 was paid, what then do we have to do? So then I have to total up. Okay, let us total up this account. So obviously the 600 takes precedence. And then you have to find the balance here. Balance CD of 200, which is going to be crossed over to this balance of forward 200. So the outstanding payable is $200. Then the other account we might be worried of is the rental account. The rental account, the rent account. The rent account, we are told that these guys paid rent $200 cash. So that's one transaction concerning the rent there. So a rent is an expense. An expense has got a debit balance, so cash on the debit side 200, which was paid. Okay, so the rent, we talked about it, and which account has not been spoken about. Okay, we talked about the purchases, but we didn't talk about the sales figure. We didn't also write about the drawings. We didn't also write about the receivables account. So I think if we do those three, we would have covered a lot of transactions or accounts. So the sales account, debit and credit. Sales on the PO's acronym, they appear on the credit side. So by default, they should have a credit balance. So we are having two forms of sales. We have the cash sales as well as the credit sales. So let's see, they sell half of the goods for cash, $800. So let us credit this account with cash 800. But they also sold the remaining on credit, for $900 to Miss X. So 900. There is a receivable there. 900. So you just have to total up. Okay, total up as usual. That's 800 plus 900. That's 1.7. on both sides. But we are going to have a balance here, balance CD of 1,700. Okay, we should come here as balance BD or BF of 1,700. Okay, do that. It can simply, sales and receivables, they are almost closer to one another, so you can't actually remember the sales and forget the receivables account. That would be suicidal. Okay, receivables account. Remember, this is the debit, this is the credit side. Okay, and receivables are assets, and by default they should have the balance brought forward. Okay, so what then happens? They emanate from sales. So initially their balance, their debit balance is from sales. How much sales were sold on credit? We are told that they were $900, which was sold to Miss X here. Okay, so $900, so $900. All right, but Miss X paid us something. She paid. We are told here that she paid something. They received something here on I. They received $500 from Miss X. So this is why we debited cash 500 and credited Miss X 500, because Miss X was reducing the receivable. Okay, so the 500 should actually come on the side of the receivables account, which is the cash 500. Then we have to total up the account. Okay, 900. So the balance is going to be the balance CD. It's going to be the difference, which is 400. And this gives us the balance brought forward 400. So this means that Miss X only owes us $400 because she paid $500 of the 900, which was the amount which she owed us initially. So she's now left with $400, which she has to settle. We can also then have to consider the last account, which has not been talking about. The drawings account. Okay, I can just write it here, drawings, or withdrawals account. Okay, this is the debit, this is the credit side. Okay, drawings. These are by default debits. Okay, they are debits in the sense that the proprietor is receiving money. Okay, or they reduce our earnings or our capital. Okay, they reduce our capital. So if they reduce our capital, they've got a tendency of being debited. So we are going to say cash and the $100 which was received by this guy. Okay, so it is ended just like that. Okay, just write it on the debit side of the drawings account. Ladies and gentlemen, I'm sure on this part we've done justice on the double entry bookkeeping system. Okay, and how do we record sales and purchases and returns? It is normal for customers to return unwanted goods to a business. Equally, the business will occasionally have cause to return unwanted goods to their supplier. Sometimes customers return goods when they bought from us because they discovered that they were oversupplied or they were faulty. So many reasons are there which might force us to receive those goods back. Okay, so when we receive those goods back, we have to account for them in our accounting books. So the double entries arising will depend upon whether the returned goods were initially purchased on credit. Okay, so originally a credit transaction, originally a cash transaction. So what happens is we need to know if these goods were bought on cash or credit. So for example, sales returns, if they were originally bought on credit, okay, we are going to say debit the sales returns. Okay, we are receiving, or sometimes it is an expense, right? Because when they come, it's almost like an expense to us. So we are going to debit, and you know that from the POs acronym, POs, the expenses are on the debit side. So whenever we are incurring an expense, we have to debit. Okay, you may consider them in the form of assets. Okay, they're being returned to us. They are assets, so they are going to be increased by debiting. So this is where we are going to say we debit the sales returns. They are goods which have been returned to us. We have to debit them. They are expenses in the sense that they are reducing our sales figure. Okay, so we debit sales returns and credit receivables. Receivables are assets. So to reduce assets, we have to credit them. All right. Initially, these goods had been sold on credit. So let's say when initially we sold goods for $100. Okay, so on credit, $100 on credit. So we had debited the receivable and credited sales. That was the initial transaction. Okay, but $10 worth of goods were returned. So $10 returned. We have to reduce this receivable by crediting it with $10. And also, okay, and also the sales figure has to be reduced by $10. So we are going to say we debit sales returns $10 and credit receivables because we are reducing them. What about if they were originally sold on cash? We're going to debit the sales returns as normal, but we are going to credit cash because we are going to refund this customer. Alright, on the purchases return. Initially, okay, what happened when we bought goods on credit? Let me just erase here. If you buy goods on credit, you debit purchases. Okay, you debit purchases and credit payables. That's initially what happened. But in this case, you have retained some of the purchases. So to retain the purchases, you have to credit it. This is why it is being credited. Okay, and you have to debit the payables to reduce the payable. In terms of the money, okay, in terms of the money, you are going to debit the cash because you are going to receive a refund from the supplier. I'm sure that one is understood. Okay, so let us go through that example and see what would be going on. For each of the following, state the double entry required to record the transaction in the account. Number 1, Alfie invests 10,000 of his life savings into a bank account. So we are told, or we are being asked to stipulate or to state the double entry which will be happening. So Alfie invests 10,000 of his life savings into a business bank account. So this is capital. He's investing a capital into the business bank account. So the business is receiving cash into its account. So we are debiting bank 10,000. This is the double entry bookkeeping, and we're not going to waste a lot of time. And then we're going to say capital, because when you inject money to start a business, that's capital. 10,000. Then he then buys goods from Isabel, a supplier, for 1,000. So 1,000 goods have been bought from the bank. So here we're going to say debit purchases 1,000 and credit bank, because we paid using the bank account. Okay, a sale is made for $400. The customer pays by check. So here we are going to say debit cash, because we've received the cash. Okay, 400. Credit sales 400. Alfie makes a sale for $600 to a customer, and she's going to pay in future. So we say we debit receivable, because this is money we are going to receive in future, but not today. So $600, and credit sales $600. You can see, ladies and gentlemen, that this is very simple, isn't it? Okay, Alfie then buys goods from his supplier coming for $500 on credit. So we are saying debit purchases 500. Credits supply coming, or payable. You can just say payable 500. Okay. We go to 6. Alfie pays a telephone bill of 150 by check. So if we pay the telephone bill, what happens is we are debiting expense telephone. Okay, just say expenses, because there might be many of these expenses, but it's okay to you can also say telephone. It's fine. Telephone expense 150. Credits. Why are we crediting? Bank, because that's where the money is coming from. Then the credit customer pays the balance on an account. The credit customer, who are this credit customer? Alfie makes a sale of 600. Okay, the 600 customer here. Alright, so the customer this time is decided to honor her account. So what happens now? Before you may actually guess how much are we going to debit and how much are we going to credit. Obviously, we are going to debit $600, which was being owed by this customer, but we are going to say bank or cash. Okay, it depends. But this customer, let us suppose they've paid using the bank, okay, the cash check or whatever. So the bank has received $600 from this customer. This is the customer we are talking about. I mean, this is the transaction we are referring to, where the customer say that they are going to pay in the near future. So that's the credit customer we are talking about, right? And then I credit this customer the receivable, because they've paid up. Okay, Alfie pays Isabel 340. Who's Isabel? If you go to number 2, he then buys goods from Isabel, a supplier, for 1,000 and pays by check. Okay? So, Isabel, do we have another transaction between Isabel and this guy? Okay. All right. Okay. Let us just assume that it was some other payable. So we just say we debit payable, because Isabel was a supplier, so let us just assume that there was an outstanding payable. So 340, and also cash should be credited. Credit cash, same amount, 340. Then bank interest of $30 is received. So we are receiving bank interest. Okay, so the two transactions here are debit bank, okay, $30, and credit income. Okay, this is interest income, because that's income, interest income. I'm sure you remember on the PO's acronym, we say that the credit side is for incomes, okay, receivables, liabilities, share capital, all right, all forms of income, the income side. Discounts received, etc., their revenues, their incomes. Okay, so interest income is going to be credited. A cash customer returned $20 worth of goods to the business for a refund. So these guys have returned the goods they have bought from Alfie for a refund. So we are being tested to tell the examiner if we understand the double entry bookkeeping system. And we say that when there is a return, okay, when there is a return on goods which have been originally sold in a cash transaction, the double entry is going to be debit sales returns and credit cash or credit bank. Okay, so we just do the same here. The double entry is going to be debit sales returns, $20, credit cash, because we are paying a refund. Lastly, let's talk about the transaction between Alfie and Carmen. Alfie sent goods of $100 back to Carmen. This is now a purchases returns. Now, the purchases returns is just the opposite of the sales returns. Okay? This is just the opposite of the sales returns. Now, before we go to the template, let us know what happened between Alfie and Carmen. If you go to note 5, Alfie then buys goods from his supplier Carmen for $500 on credit. So this was a credit transaction. So the purchase returns is applying to a credit transaction. So let us see what's going on. Now, this was a payable, and a payable is being reduced. Now, when you want to reduce a payable, you have to consider that on the PO's acronym, a payable is a liability. Okay, so to reduce a liability, you have to debit it, debit payables, okay, by $100, and credit purchases returns. $100. This is what is being illustrated here, and this was a credit transaction, so the applicable entry is this one. Okay, we can move forward, ladies and gentlemen. Now the trial balance. This is just the list of account balances and is prepared once the accounts have been balanced off. Now, the issue of balancing transactions, we have done it where we were totaling the debit and the credit side and found the balance brought forward, etc. That was balancing the accounts. Okay, so a trial balance looks like this. We've got a trial balance title, okay, as at 31st December 2005. We've got the name of the account, okay. For example, this is sales, purchases, receivables, payables, capital. But one thing you have to notice is that the sales, the PO's acronym still takes charge. The PO's acronym still takes charge for you to understand the trial balance. Sales on the PO's acronym, the sales here, they're on the credit side. Similarly, in this case, the sales are also on the credit side. This is the credit, this is the debit column. Okay? The purchases on the PO's acronym, here, the purchases, they're on the debit side. Similarly, here on the trial balance, they're also on the debit side. Receivables are assets, they're on the debit side of the POs. Here, they're also on the debit side. Payables are on the credit side. They brought their liability on the PO's acronym. Here, they are also on the credit side. Capital is also on the credit side. So, but one thing for certain is that the trial balance should balance. This is why they call it a balance, a trial balance. Both the debit and the credit should tally. They should have the same amount. So the trial balance should balance. What does the trial balance prove? The trial balance will balance if for every debit entry made, an equal credit entry was made and the balances were correctly extracted and cashed. Thus, the purpose of the trial balance is to check that for every debit entry made, an equal credit entry has been made, to act as a first step in preparing the financial statements. Closing off the account. Now that we have recorded all the transactions and have checked that the double entry is correct, we are in a position to produce the financial statements. We do this by examining each account in turn and closing off. The rules for this are as follows. Statement of financial position items. These are assets and liabilities. They exist at the end of the period and still exist at the beginning of the next period. We therefore simply leave the balance on the account. Then, statement of profit or loss items. These are total item, total income or expense for the period. We have now finished with the current period, but we wish to use the same accounts to record the income and expenditure for the next period. We do this by opening a new account in the nominal ledger called statement of profit or loss. For items of income, the entry is debit the income T account and credit the statement of profit or loss account. For items of expenditure, the entry is debit the statement of profit or loss account and credit the expense T account. Here, what we are simply saying is that we have to close the expense account and transfer it to the statement of profit or loss. How do we do the transfer? We know that the expense account is a debit balance by nature, so obviously to close it, we then have to originate a credit entry. Okay, we close that one by creating a credit entry so that the expense account we have a 0, so that we know that it has been closed, and then the transfer should be made to the statement of profit or loss. Now, let's take the ratio example further. Okay, let us take the ratio example further. Okay, for the previous example on ratio, open a statement of profit or loss T account and close off the account. So that's what we just have to do for now, so that we know that the ratio problem was actually a hectic one, the ratio problem. So let us just try to comply with the requirement. This is the ratio problem, ladies and gentlemen. I'm sure you have jotted down the problem, and you can also replay the video for you to understand what is actually going on. But I'm sure we did everything, and everything is above board. The capital account, okay, with that we did all that. All right. So what we only need here, ladies and gentlemen, is to come up with the statement of profit or loss. Everything for accounts there, they are right. So let us just come up with the statement of profit or loss for this. Okay. All right. Okay. I think for the income items, that's where we need, because we need items which should appear. Okay. For balance sheet items, it's not a problem, but for statement of profit or loss items, that's where we might be having some challenges. But let us see what would happen. Okay, the rent is a statement of profit or loss item, so we just have to ensure that we have closed it. Okay, just have to ensure that we have closed this account. All right. Let us just use this color. So for rentals, we just have to say that statement of profit or loss. Okay, statement of profit or loss. That's 200. That's the credit. This is the credit entry which we are talking about. Okay, we've made a credit entry here so that a transfer has to be made to the statement of profit or loss. The purchases account as well should also be. So we also need to open up. All right. Okay. So I think we just need to write everything down here. All right, let us just do it. Let's just close these accounts individually. We can either start so that we do not clutter our workings. Okay, the cash account, if you still remember, the cash account had a balance brought forward. If we go back to our ratios workings, the cash account, let me just erase this so that you won't be confused of what is going on. All right. Okay, the cash account is here, ladies and gentlemen, where we are saying the balance brought forward was 4,100 debit. Okay, so we just extract that one as it is. Okay, debit. So we are having the balance of 4,100. So for the cash account is not a problem. The capital account, here again we know that the balance injected for the capital is 5,000. So balance sheet items are not actually a problem. Okay, similarly for the car, the car account. The car account, we know that the car was bought for 1,000, and this was the balance we obtained in our initial ratio example computations. All right, but when it comes to the purchases now, the purchases T account, purchases account. All right, the purchases account here, the purchases account here, you can see that we are having a balance brought forward of 1,100, but we have to ensure that this balance has been extracted to the statement of profit or loss. I wanted to write it there, but I found out that the work could end up being a clutter. So we know that the purchases have got a debit balance of 1,100. That's our balance for the purchases, balance 1,100. But we know that we have to make a corresponding credit to ensure that this balance has been netted off. So you can just do this. 1,100, 1,100. So the transfer here is the statement of profit or loss, which should also be 1,000. Sorry, the pen is misbehaving. Okay, 1,100. That is a transfer to the statement of profit or loss. We have also an account for payables. The payables account, if we know that the payables should have a credit balance. So, but let us just look for this balance at the ratio example. Here, the payables had a balance of $200. So that's the balance we are going to just take and slot in our example here. So the balance is $200. We then have to talk of, remember, payables are just balance sheet items. They are not going to be transferred to the statement of profit or loss. We've got the rent account. This one now is a statement of profit or loss item. Rent is an expense, so expenses have got a debit balance. So balance for rent was $200 from the question. So we just have to total up 200. So the statement of profit or loss transfer is going to be 200. So here we are just closing up this account to ensure that these items have been transferred to the relevant financial statements. For balance sheet items, it's not going to be a problem because those balances will just remain as they are. They are going to be used in the next period. But for the statement of profit and loss, those items are only valid for their particular year, for that current or particular year, which is under review. So this is why you see there is a lot of totaling up and closing up for these accounts. We have got the sales account, which is also a statement of profit or loss item. So sales by nature are credits, so we expect you to find the balance for sales written on the credit side, and we are told in the ratio example that the sales figure, the sales were 1,700. So we just take that figure and slot it here, 1,700. Now we need to close up this account and just have to total up 1,700, 1,700. So which means the transfer to the statement of profit or loss should be on the debit side here as 1,700. Okay, which account is left? We didn't talk of the receivables. Receivables account. The receivables account. Receivables by nature are assets, so we expect to see their balance on the debt side, and these receivables, they affect the SFP, the statement of financial position, but not the statement of profit or loss. So there is not going to be transferred to statement of profit or loss. Alright, then we've got withdrawals or drawings, and I say that their balance is on the debit side. Okay, now after we do this, we then have to come up with this statement of profit or loss. The statement of profit or loss. This statement is not called the statement of profit and loss. No, that's not it. It is the statement of profit or loss. Okay, you can put it in a T account, or usually it is presented as a vertical, in its vertical format, but it is actually a T account. Alright, so on the credit side, the credit is for income, and then the debit is for expenses. It's just the PO's acronym, which we will be talking about from day one to the end. Until you become a qualified accountant, you'll be just talking about the PO's acronym. So do not feel intimidated. So we can start on the credit side by sales. Sales figure was 1,700. Okay, and no other income were spoken about, so only sales. So let us go to the expenditure side. We are having the purchases. The purchases figure was 1,100, and then the rent, which was 200, and then what else do we have? Okay, what else do we have? We have nothing anymore. So if we don't have, we just have to let us see if we don't have another statement of profit and loss item. We talked about the purchases. Let me use another pen. We talked about the purchases. Okay, we talked about this transfer, and then the rent. We talked about it. Okay, so you can see that in the sales here. So nothing more. Withdrawals, these ones do not appear in the statement of profit or loss. If a business owner takes out money, that's not an expense. Okay, those are withdrawals or drawings which only affect the profit. Okay, they affect the profit of the company or the capital itself. So that's an SFP item. So what happens here? We're going to have the larger amount is 1,700, which should appear on both sides, and then get the balance here, the balance, and I want you to give me this balance. The name of this balance, which we are going to check here, is balance as the balance brought forward. What's the name of this? There is actually an accounting name for this balance. It is called the profit. Okay, that's the ultimate profit, the net profit. So in essence, the statement of profit or loss looks like this, ladies and gentlemen, and I don't want you to be lost along the way. Let's move on. Okay, so we have done with closing off accounts, balancing remaining, the balance, of determining the balance remaining on the statement of profit or loss account, that is the profit or loss for the period. Now we can produce a printed version of the statement of profit or loss suitable for presentation to the owner by rewriting the figures from the T account in the standard format. The balance remaining on the accounts or represent statement of financial position item. We can now list them in the standard format to produce our statement of financial position. Note that this preparation of statement of financial position and statement of profit does not result in any additional entries in the T accounts. So, with regards to the ratio example, we can now prepare the statement of financial position as well as the statement of profit or loss in a more standardized way. Okay, in a more standardized way. All right, we can do that. We can do that. That's not a problem. Okay, that's not a problem. All right, so let's start with the statement of profit or loss. Statement of profit or loss. Okay, we start with the sales. This is the standard format we are talking about, ladies and gentlemen. And then less, okay, less costs, cost of goods sold, okay. And we are only told of the purchases in this case, which were from our purchases figure was 1,100, okay. Then we get what is called gross profit. Gross profit here is 600, and then less other expenses, where we have got rent. The rent was 200, and do we have any other expenses? There's no other expenses there, so you can see that the profit becomes 400. Okay, this is the profit or net profit. Net profit $400. Now the statement of financial position. Statement of financial position. We start with the assets. Remember, this is an equation. Assets. What we are saying, we've got non-current assets, the non-current assets. Okay, the non-current assets. Okay, you may also decide to have these two columns there. The non-current assets were how much? We've got a car, which is a non-current asset. We are just using this information, ladies and gentlemen. Okay, we've got a car for $1,000. Got a car, $1,000, and then we've got all right. I should have written car here and say $1,000. So let me just erase that one because I have to teach you the right thing. Okay. Now we have got current assets. Current assets, where we have things like receivables, cash. We all know that all the inventory was sold up, so there was no inventory at the end of the period in the case of Rachel. So what happens is, ladies and gentlemen, when you are writing a statement, whatever, a statement of profit or loss or a statement of financial position, what happens is you must first state the name of the business. In this case, it's Rachel. Okay, Rachel, statement of financial position. For the statement of profit or loss, we should have put the name Rachel on top. And then write the statement of profit or loss for the year ended. For the year ended 31st December 20XX. The year, right? Similarly, for the statement of financial position, it is statement of financial position as at 31st December 20XX. Okay, data there. Now, the receivables, we just use the amounts from the question. We are told that after balancing off everything, the receivables were 400. And what about the cash? The cash account, what was it telling us? The cash account was saying that there was 4,100. So we take those two figures. Okay, we take those two figures. The cash account, the receivables were 400. The cash was 4,100. We add them up and we get 4,500. 500. Then you have to add with the non-current assets, and we come to 5,500. That's the assets for the business. They should tally. Remember, there is this accounting equation. Assets is equal to capital plus liabilities. This is the balance sheet equation. Okay, so this 5,500 should equal capital plus liabilities. So let us now do the capital and liabilities section. Capital and liabilities. So we start with the capital, which was injected by the owner. The owner injected capital about how much? 5,000, if you still remember. 5,000. Okay, this is the capital which was introduced by the owner. Capital introduced. Okay, here you can also put the heading capital here, right? To tell the examiners that you are talking about capital here, all right? Now, ladies and gentlemen, capital also includes what is called profit. This guy made some profit. The profit figure, we found it from the income statement. This 400 is the profit we are talking about. So the profit the business made was 400. Then we have to less drawings which were made by the owner. The owner makes drawings from profits. Okay, from profits. So we then have to come up to 5.3. Then let us now talk of current liabilities. There were no issues to do with long-term liabilities, but current liabilities. Okay, current liabilities. We are told of the payables. If you come back here, there were some payables of $200. So the payables were worth 200. Okay, payables were worth $200. So if you add them up, the capital, this is the capital 5.3 plus the liabilities of 200, you are going to come to 5,500. And this is the same amount as this one, 5,500. Okay, I hope, ladies and gentlemen, when it comes to double entry, you are now home and dry. So let us now quickly go to the accruals and prepayments. Remember, before you produce your financial statements, there are certain adjustments which you have to make. So the first adjustment we are going to worry about in this lecture is the accruals and prepayments. We are also going to do depreciation, petty debts, and inventory as we move on. But for the purpose of this week's lecture, we are going to dwell on accruals and prepayments. Now, upon completion of this part, you should be able to explain the need for adjustments for accruals and prepayments in preparing financial statements, illustrate the process of adjusting for accruals and prepayments in preparing financial statements. So that's our business for the day. And as you can see, the accrual concept, or sometimes it's called the matching concept, okay, talks about the expenditure and income, okay, but not cash receipts. These ones are actually not issues to be worried of, okay. You may incur an expense despite the fact that you have paid anything, but we have to recognize that we have made an expense or you have received income, despite the fact that you were actually paid by the customer. Okay, so that's the the accrual concept. So we have got two forms of expenditure. We've got accrued expense as well as prepaid. Similarly, in the income context, we also have got accrued income and prepaid income. All right. Now, accrual basis of accounting. The accrual basis of accounting means that to calculate the profit for the period, we must include all the income and expenditure relating to the period, whether or not the cash has been received or paid, or an invoice received or not received. So we have got this issue here where we'll be saying the income earned less less expenditure incurred is equal to profit. This is the basis on which we prepared the statement of profit or loss. Okay, or the statement of this one. Okay, so we just assume that we only record the income that has been earned in that particular period vis-a-vis the expenditure that has been incurred, regardless of the fact that the cash was actually received or paid. So, accrued and prepaid expenditure. Accrued expenditure. An accrued expenditure is also an accrual or a liability. It is also called an accrual or a liability. Okay, the reason why accountants treat accruals and liabilities is because the business would have incurred the expenses but did not pay for those expenses in that particular period. Okay, so they say that they are expenses which have already been enjoyed by the business, but the business did not pay by the time their year-end arrived. So what then happens? They have to debit the particular expense account, okay, and credit the accrual. All right. This is the double entry that is recorded because the business would have enjoyed the expense but did not pay for it. So an accrual arises where expenses of the business relating to the year or end accounting period have not been paid by the year end or end of that accounting period. Now, let us go through this example together to understand the issues to do with accruals and prepayments. Alright, Ahmed started business on 1 April 2000 and during the year to 31st March 2001 he made the following payments in respect of telephone. On 18 July 2000, Ahmed paid $500 for the 3 months to 30 June 2000. On 20 October, Ahmed paid $600 for the 3 months to 30 September 2000. On 14 January 2001, Ahmed paid $750 for the 3 months to 31st December 2000. As at 31st March 2001, Ahmed estimated that $950 was owing for the 3 months to 31st March 2001. He had, however, not received a bill from the telephone company. So, show the extracts from the statement of profit or loss and statement of financial position. Write up the T account for telephone for the year to 31st March 2001. Then you have to close off the account. So, our job there has been made easier. We can start with the telephone account. So, telephone account. The same T accounts which we have been doing. So, these are the payments, okay? These are the payments which have been made, alright? These payments, remember, a telephone expense account is an expense account, and all the PO's acronym, we just have to put them on the debit side. Okay, cash, we first paid 500, followed by cash, 600, followed by cash, 700, Okay, but what is our year end? Okay, the business started on 1 April, so the year end is 31st March 2001. Okay, so the last payment which was made on 14 January 2001 of 750 for the 3 months to 31st December 2000. Okay, as at 31st March 2001, it estimated that 950 was owed for the 3 months to 31st March 2001. He had, however, not received a bill, so which means that the 950 was not paid for, but it is actually an expense within that period. So it is an applicable expense. So we record this expense, but we do not pay for it, so it is an accrual. 950. Alright. So we then have to total up. To total up, we get 2,800. So here we're going to have a statement of profit or loss transfer of 2,800. Alright, and then we can come up with the accruals account. To account. And the accrual is a liability, so liabilities, they're having a credit balance 950. Why? Because this one is yet to be paid. So the extract statement of profit or loss, extracts. We have got the statement of profit or loss extract. Okay, here under the expenses, telephone, we're going to record the full 2,800. Not only the accrual component, but everything else has to be considered, because the statement is within, the expense, including the accruals, were within that particular period. Okay, but in the statement of financial position, the SFP, okay, we are going to have under current liabilities. Current liabilities, we are going to have telephone, 950. We need to pay that one to ensure that we have settled our account. Now, the prepaid expenditure. A prepaid expenditure is an asset. Okay, what is an accrued expenditure is not an asset but a liability. So we have done the liability part, which was the accrued expenditure. We now go to the prepaid expenditure. A prepayment arises when some of the following year's expenses has been paid in advance, has been paid in the current year. In this case, it is necessary to remove that part of the expense which is not relevant to this year and create a corresponding balance sheet asset called a prepayment. So we are going to debit the prepayment and credit the expense account. By crediting the expense account, we are reducing the expense account with that prepayment. Okay, and by debiting the prepayment, we are creating an asset or increasing the prepayment account. So let's go through the example. Okay, to the Wardlaw pays the rental expense on his market store in advance. He starts business on 1 January 2005 and on that date pays 1,200 in respect of the first quarter's rent. So this guy started business on 1 January 2005 and on that day pays 1,200 in respect of the first quarter's rent. During his first year of trade, he also pays the following amount. So he also paid the following, these amounts. All these amounts were paid. Okay, this was in respect for the first quarter to June of the quarter ended 30 June, and then on June he paid for the quarter ending 30 September, and September paid for the quarter ended 31st December. Then on 13 December he paid in respect of the quarter, the first quarter of 2006, 1,400. Show the transaction in the rental expense account. Remember, this guy's year end is 31st December, all right? But he paid for the three months into next year. So what then happens? The other months which were paid for the next year's quarters is a prepayment. Okay? So let us come with the rent expense account. Rental expense. This is a T account, ladies and gentlemen. Do not feel intimidated with these. And I said rental expense is an expense account which is on the PO's acronym, should have some debit balances by default. So whatever payment we make in respect of this account is going to increase the expense account. So we're going to say cash, okay, cash 1,200, which was paid initially on 1 January. He paid 1,200, and then he followed by another 1,200, another 1,200, and then 1,400. Okay, but he then paid this 1,400. Okay, we also have to record it in this expense. We just record everything. Cash, again 1,200 cash. You may write the date like 1 January so that you won't confuse this cash. We say we've got the 14th June. We have got 25 Sept cash, and here it was 1,400, here 1,200, and then on 13 December we paid cash, which was 1,400. Then you have to add up. Do not worry in the moment. Just follow. Okay. Then we know that this last payment was not for this period, so we then have to say prepaid payment 1,400. Okay, so and the statement of profit or loss transfer should be the balance here, which is equal to 5,000. Okay, the prepayment, this prepayment should be carried forward to be quoted in the next year's expense. So prepayment. Prepayment carried forward. Okay, carried forward, balance put forward. It's 1,400. Okay, that's it, ladies and gentlemen. We have done it, and can move on to the next one. That one we have to do it. Okay, let us just give it a quick go through. Our current started business on 1 January 2000. During the year to 31st December 2000, she made the following payments for insurance. So 5 January 2000, she made a payment of 800 for the 6 months to 30 June. And then she made on 15 June 2000, she made 2,000 for the 12 months to 30 June 2001. So show the extracts and so forth. So we just need this. Do the same thing. An insurance account is an expense account. Insurance account. This is an expense account like a telephone account or rent account. So what happens is there were payments which were made. These payments, okay, 800 and 200. Okay, so there was cash 800 just paid for the insurance, and then cash 2,000. Okay, add up get 2,800. All right, but we know that this 2,000 included an expense 12 months. All right, we started our business on 1 January 2000, so our year end should be 31st December 2000. Okay, but midway, our first payment was 800 for the 6 months to 30 June. Then we were left with 6 months, but we paid for 12 months to come. So the 2,000 should be split halfway, 50% for this year and then 50% for the other 6 months next year. So that's 1,000 should be for this year. So there was a prepayment of 1,000. Prepayment CD. Okay. Then the statement of profit and loss transfer is the difference, which is 1,800. Then we will have a prepayment here, prepayment brought forward of 1,000. Simple, isn't it? Then the prepayment account also, this is an asset, so it's got a debit balance insurance. It is an asset because we are going to enjoy these benefits next year without paying. Okay. Now, after we do this, we then have to come up with the extracts. SFP, the extract. The extracts. Statement of under expenses. The expenses which we are going to record are these ones for this year only. Okay, where we are saying insurance. The insurance 1,800. Now the extract statement of financial position under the current assets, because we say that the prepayment is an asset. We're going to say current assets, then prepayment 1,000. That's done. Due done. Due settled. Okay. Now let's go to the income side. We've got accrued as well as prepaid income. Accrued income. Accrued income is an asset. Accrued income arises where income has been earned in the accounting period but has not yet been received. Okay, in this case, it is necessary to record the extra income in the income statement and create a corresponding asset in the balance sheet called accrued income. So we debit accrued income, all right, that is in the balance sheet because it is an asset, and then credit income. So you just have to be very careful. Not every income is going to have to be credited, to be considered in the pure blinded way. Okay, while you just have to follow the same PO's algorithm, you just have not to be blindfolded. Okay, so do not be vexed there. All right, we are saying that this is in some form of a receivable. Okay, it is a receivable because you have earned this, but they have not paid you. So in your books, it's almost like a receivable. It's an asset. So you debit the receivable, you debit the accrued income, okay, and credit the income, the normal way, the normal PO's acronym way. Okay, a business earns bank interest income of $300 per month. Okay, that is 3,000 bank interest income has been received in the year to 31st December 2005. What is the year-end asset and what is the bank interest income for the year? Show the relevant entries in the ledger accounts. All right, so one thing we have to just be clever about is that we are told, we've been hinted by the examiner that these guys earn 300 per month, And we know that the full year has got 12 months. So if we multiply 300 by 12, we get 3,600. This should be the total amount this guy has to receive. But instead, they received only 3,000. So what was the balance? Their balance. The receivable is 600. The accrued income, that's 600. So how are you going to, what is the double entry there? For this accrued income, we say that you have to say debit accrued income $600 and credit bank interest income. So simple, isn't it? Okay, so what then do you have to do with the okay, you can present this information easily by saying you just have to come up with the interest income account, T account. Okay, where we say that since it is an income account, okay, since it is an income account, whatever that comes should go to the to the credit. So that's bank. We are receiving. We received 3,000. Okay, but we know, all right, we know that we have earned how much. That is to go to the statement of profit or loss. We should recognize 3,600. Okay. So, what is our accrued income? Carried forward or CD, accrued income CD should be 600. Okay, accrued income 600. That's it. Now, the last part is the prepaid income, which is a liability. Okay, prepaid income. Let's say you are paid in advance before you do the job. Okay, if you are paid in advance, okay, you should treat that income as a liability. That's deferred income. You should treat it as a deferred income. It's a liability. Okay? Prepaid income arises where income has been received in the accounting period but which relates to the next accounting period. In this case, it is necessary to remove the income not related to the year from the income statement and create a corresponding liability in the balance sheet called prepaid income. So, you debit the income and credit the prepaid income. That's a liability. That's recognizing a liability. Okay. A business rents out a property at an income of $4,000 per month. $64,000 has been received in the year ended 31st December 20x5. Okay, what is the year-end liability and what is the rental income for the year? Show the relevant entries in the ledger accounts. We know from our discussion that we have to calculate what this guy has to receive in a particular year. We say that in a year there are 12 months, but he receives 4,000 a month, so his total should be 48,000 per year. Okay, but instead of receiving 48,000, he received 64,000. So there is a liability of how much? If we say 48 minus 64, there is almost about 16,000, which is a liability. Liability. He has to pay back, or this should be that's a liability. Okay, That's a liability because the tenant or his tenants are going to enjoy without paying for that 16,000 extra. Okay, he has to ensure that the proper accommodation is there, otherwise he's going to be sued because he has received money for those ones. So that's a liability. He has to satisfy the owners of the money by providing the accommodation. Okay, so the true amount credited to the income statement in respect of the rent should be 40,000. This should appear in the statement of profit and loss. And then the year-end prepaid income liability is going to be 16,000 that has been received in respect of the next year. The double entry required is rental income, 16,000, and then credit prepaid income, 16,000. So we're going to have this rental income account where we are saying that the transfer to the income statement should be this one, and then the prepaid income 60,000, and we have got this one. So this is it for the prepaid income. Yes, prepaid income transactions. All right, but there is a certain template I want you to be accustomed to in your studies. Okay, you just have to ensure you are comfortable with this template. Otherwise, there's going to be some problem if you do not master it. All right. Ladies and gentlemen, we've realized that we've got the expense and the income, where we've got expense accrued or expense prepaid. Okay? In the exam, you might be given a question from either the expense side or the income side, but this template is going to help you in your exam. All right? So for the expense side, all right, every prepayment that had been paid in the previous period should come as a balance brought forward debit. Okay, and then any payment which you made should also increase the expense. All right, and then you have to close your expense with the accrued, the accrual balance. Right. Then on the remember, this is the debit and this is the credit. This is the debit. This is the credit. Then on the credit side of the expense account, you just have to have a balance brought forward accrual. Okay, your accrual should be the balance brought forward on the credit side, and then you just have to have the profit or loss transfer on the credit side as well. Then you should have a closing prepayment on the credit side. So if you just remember the expense, how the expense is or is presented, then you have, even if in the exam the income side, a question from the income side has been given, just have to know that the income side is the reflection of the expense side, okay, or the expense account. The income account is a reflection or is a mirror of the expense account. So let us do an example to illustrate this further. Okay, Marcus' telephone expense ledger account for the year ended 31st December 2021 showed the following: prepayment brought forward 500, cash paid 6,300, accrual carried forward 850. What amount should be charged to the statement of profit or loss in the year ended 31st December 2021 for the telephone expense? Now, we are given them those choices. It's not an issue of just guessing out these choices. If you have a habit of guessing, you're actually going to fail. So please, I want you to pay attention, okay, careful attention to my presentation. We know that there is a template. This is an expense problem, so you just have to memorize the expense. This is the expense account template. So just have to memorize this, and we know that according to the expense template, okay, the expense template, we're going to have as our balance brought forward the prepayment, then cash, then we're going to have a closing accrual. Okay, on this side we have the accrual brought forward, then the statement of profit or loss transfer, as well as the prepayment brought forward. Closing, CD. These are the brought forward we are talking about, and these ones are CDs. Okay, so let us try to use this template in our problem. So we can just say telephone account. Okay, this is the telephone account. We are given the prepayment brought forward, so prepay brought forward was 500. Then the cash paid, the cash 6,300. Let us just use the template, ladies and gentlemen. Then we are having the accrual, CD, or credit forward CF, that is 850. Okay. On this side, the credit side, there is nothing, no other information that was given. So the only information that is going to happen, or that we are going to have, is for the charge to the statement of profit or loss, which is the balancing figure. So if you add them up, if you add these figures up, that's 6.8 plus 850. Let us just try to use our calculators so that we come up the good working. So that's 500 plus 6,300 plus 850. That's 7,650. 7,650. All right, 7,650, and you can see that because we do not have other information, only the only balance we can have is 7,650, which was transferred to the statement of profit or loss, and this, our answer is D. So simple, isn't it? All right, is there anything which I left here? I think there was a question which I skipped. Right, because I don't want my students to be found wanting. Okay, I don't want you guys to have a problem in your studies. You just have to relax. Okay. All right, there's the issue of subsequent accounting periods. Okay, example carrying continued. During the year to 31st December 2021, Karen made the following payment in respect of insurance. Okay, that is 12 June 2001, paid 2,400 for the 12 months to 30 June 2002. Show the extracts from the statement of profit or loss, statement of financial position, and then write up to your accounts for insurance and for the prepayment for the year to 31st December 2001, and then close off the account. You can see that this is just the same thing, okay? And we know that this amount went into another future accounting period, the 2002 figure. So it is the $2,400 should be split between 50% for this current year and then 50% for the other 6 months of 2002. So that's it. We can just do this to just ensure that we've covered everything. Okay, we are having a prepayment, ladies and gentlemen. We are having a prepayment. If you still remember from the example on Karen, there was a prepayment. I'm sure this is the current example we are talking about, where we say that the 2,000 here was split. Okay, it was split $1,000 for the 2000 for year 2000, and another $1,000 for year 2001. So this is why here, ladies and gentlemen, we are saying that we are going to have a prepayment. So the prepayments account is going to have the balance. Remember, it is an asset balance put forward of $1,000. Okay, and then insurance 1,000. All right, that you have to cross over, close it. Okay, and then that was the prepayment account. And then we have an issue for the insurance account. The insurance account the insurance account, we have got prepayments of 1,000. Okay, then cash which was paid for insurance 2,400. But we know that in this cash, okay, in this case, the 2,400 includes 6 months for this year and 6 months for next year. So we just divide by 2, and we can say that the prepayment was 1,200. Okay. And we know that this is 3.4. Then the balance is the transfer to the profit or loss of 2,200. So what are the extracts now? Extracts. We've got the statement of profit or loss extracts. Okay, under the expenses, we have got insurance expense. The insurance for this year should be this one as reported as a transfer to the profit or loss 2,200. What about the SFP extract under the current assets? Current assets should show us a prepayment of 1,200, which is this one, because it relates to the future year, the next financial period. Okay. All right. I'm sure we have done everything that should be done. If you feel you need more help on this part, I will always be there for you. Okay, in your tutor, I will always ensure that my students get the best of coaching and best of help whenever they want it. So I'm signing out, and if you enjoy the lectures, don't forget to spread the word to your peers, to your friends, to other groups on social media, everywhere, so that they also benefit and our school grows. Until we meet again, may the good Lord help you and bless you. Thank you.